Yeah, I think the biggest takeaways from the conference so far is that a lot of people are quite early in their journey in terms of understanding the regulatory expectations, but then also trying to navigate all of the data that's out there that might or might not be useful for them when it comes to addressing a response to that in terms of the way that they manage their businesses. From my perspective, there's definitely a lot of education that needs to happen. So we live and breathe this topic every single day at Climate X. We definitely need to take a step back to make sure that individuals who are becoming responsible for doing the work on the client side, they've got confidence in the topics of climate change, ESG more generally. And so there's an educational element, but then also translating that into action into their businesses. So actually, how do they take this data and do something meaningful for it? So it's definitely the start of a journey, and it somewhat mirrors what we've seen in other parts of the world. But we've got really good sentiments to want to get things done properly. So we're excited about the progress that's no doubt to come. I expect that the regulated markets will be the ones that will perform the best, predominantly because the pace of the change will be driven by places like central banks, for example, who are forcing financial institutions to start assessing climate risks and take those first steps. A lot of other folks, I think they want to get to perfection and they want to be really confident before they mobilize budgets and action into some sort of response. But the danger that we have here is that there is no perfect answer in terms of data quality, in terms of the embedding of that data into businesses and what that means for the way that we account for climate risks or we manage business decision making as a whole. And so my expectation is that those that start to take the first steps more quickly will be the ones that get ahead longer term because they'll build those teams and resources and confidence. Real estate comes into that because they're being directly affected, and we're certainly seeing that firsthand on our side. The laggards, and I think the ones that we're expecting more challenge, will be in traditional industries, in places like oil and gas, mining. Now, it's not from a transition point of view, as in will they start mobilizing, because they are, but they've got a lot more to do when it comes to getting themselves to net zero, for example, or to start accepting climate risk within the way that they manage their businesses without conflicting with the other interests that the shareholders have. ESG-related regulations coming in different forms. There's a bit of a positive impact in the fact that they're happening and people are being forced to start providing disclosures that help us understand a new risk category, right? So that's great that that's happening. The issue is that there are different types of guidances coming in. Sometimes they conflict, sometimes they add too much to the scope that is already difficult for these folks to understand, much less than to improve the broad coverage that they need to have when it comes to reporting. But the positive elements, I think, will be that investors and shareholders will get a more transparent view of what they're investing in and where they're putting their money, right? So if I'm starting to recognize that my balance sheet is overvalued or my P&L doesn't reflect potential losses that might come, then absolutely I can make more informed decisions about the way that I price a business if I'm going to invest in it. On the contrary, it also gives great opportunities for transition and transformation. And wherever there's disruption, there's always opportunity to grow into new markets, provide new services for customers, and really start to develop new revenue lines and ultimately build a more sustainable business. And these are the types of questions that decision makers are starting to answer now when it comes to thinking about ESG, when they think about climate change as a whole topic. It's becoming more important, more prudent that they do this so that they identify not just risks, but also opportunities to grow the business. Actually, it's not my first edition at GRI because I was at Europe GRI last year. So that was filled with a great room of people. Initial conversations actually where people were speaking about ESG, not because it was a topic that was dedicated in those conversations, but because it was starting to come up in conversation. This year, what I'm seeing is similar is happening where there's a lot of ESG types of conversations feeding into other parts of the discussions that are being had because it's proving to be an enterprise-wide ubiquitous risk that affects everybody everywhere. So for me, it's been positive to see that a lot of people are embracing the change. I can see the progress in the last 12 months of the conversation in terms of sophistication, the experiences handling data, exploring the markets, and also really think about how they connect the dots. And I think that's where the conversation's changed from what is the data, what is this topic, what are the basic definitions, to how do we take this data and start to do something useful with it in a scalable way.